what is your answer to the magical question, is now a good time to buy?
Great question. So I always advise my borrowers that if they've got, so we got to remember, we're in the shelter business, right? This is truly a place to live. If we take the investment piece out of the equation and we really focus on the client and for a place to live. So if you can afford the payment, if you've got, the down payment, if you've got the assets to have your house payment go on if something were to happen to your job or your career or your financial situation, if you're able to make that payment, I do think it is a good time to buy a home.
Hey everybody, how's it going? Jason Walters here. Thanks for joining in on another one of our videos. Today I have with me Chris Conlon, good buddy of mine. He is at Movement Mortgage, and today we're going to be talking about the state of the interest rate market. Where are we headed? Chris, thank you so much for joining me. Why don't you tell us a little bit about yourself,
Sure.
Where you're at, and how long you've been in the mortgage industry?
Jason, I really appreciate you having me, man. This is my music, and you're allowing me to play it, so I really appreciate that very, very much. This is my passion. I have been in Ventura for the last 44 years, my entire life.
Oh, wow.
And I truly love this town. I love the community that we've built, and I'm excited for the directions that we're heading. So I'm a regional builder manager. I cover the West Coast for Movement Mortgage. And again, like I said, very passionate about what I do. Helping others and serving others is truly my vocation. And I'm so stoked that I've really figured that out over the last 20 years. And here to help out. So if I can answer questions and kind of guide you through this crazy market in terms of interest rates, that's what I'm here to do.
Well, yeah, man, that's what is on everybody's mind. I mean, I just seen this morning, opened up the news feed, and there's everybody talking about the new interest rate hike. Mm-hmm. So why don't you tell us a little bit about that? What is going on in the interest rates right now that has everyone going crazy?
Yeah, sure. So I think what the main thing is there's so much volatility, and we've seen in 2022 a ton of volatility that we haven't quite seen probably in our real estate careers. Since the pandemic, we've had some really extremely low rates in the 2s and the 3s. And in the last 6 months, we've seen rates go, over 7%, which is wild, right? So I think the volatility has kind of got everybody a little bit wigged out. I think the amount of volatility in a day. So typically as a lender, we see mortgage rates move, sometimes a couple of times per week, right? Or maybe a few times in a day would be an anomaly. We just don't see that. As of the last 6 months, we have seen rates move sometimes 5-6 times per day, right? So a rate quote that we quote you in the morning could be obsolete literally in 30, 40, 50 minutes, right? Which that's got everybody wigged out. So I will tell you that there's relief on the way, and we're going to get to that here in just a little bit, but just hold on tight. We have some relief coming, which I'll explain why. I'm not anecdotal. Let me look in my crystal ball, although there is, some real data points that show that rates should come down relatively soon. We'll walk through that.
All right. Awesome. Well, it's the funny thing is hearing you say that is, I've been in the business for a while as well. And I remember when people were happy to get a 6% interest rate. It was like, awesome.
Sure, absolutely.
So, but now over the last couple of months, I mean, the same house, it's the price almost doubled with the payment. Sure. So it is a little bit different than those 2s and the 3s, huh?
Absolutely. So with a 6%, with a 7% interest rate, you got to know that for me, myself, I am team higher rates, right? And you'll hear me say that again. I am team higher rates. The 2s and 3s, what happens, and you've seen it as a real estate agent, especially with a high producing real estate agent, you've seen the affordability, and that was driving house prices higher and higher month over month, right? So, and you had this frenzy and this FOMO in the last 2 years where it was so emotional, right? And we had clients that would waive contingencies. They would go in cash and then start going over the asking price, right?
That was crazy.
That stuff is not healthy for our housing market. So with the higher interest rates, now I'm not team 7%, but I'm team higher rates maybe in the 4s and the 5s, maybe even in the 6s in some cases, because that will help the inventory get to a more healthy level. We really want to get to that 1.2 to 1.9 million, 6-month inventory. That's a very healthy trading market, and these higher rates will help accomplish that. So I am team higher rates for sure.
Well, I know some people that will disagree with you that aren't happy about these higher rates.
Sorry about that.
I know that. I was going to say, I know a lot of sellers, or would-be sellers. They're not even thinking about selling because they have a super low rate,
Sure.
and they're not going anywhere because the rate would at least double if they were to move somewhere, which which is going to be a little bit less inventory,
Sure.
on that end.
As we start seeing a change, and I'll tell you what interest rates are based upon. So what we're facing right this very second, this kind of goes back to your volatility piece. Our inflation numbers, right? Inflation is what drives mortgage rates. So I want to make everyone understand that when you think about the Fed funds rate, so when we hear the Fed is going to raise interest rates, that is not a direct correlation with mortgage rates. Those are short-term interest rates. So think of like your car loans, your credit cards, personal loans, home equity lines of credit. That's what's directly affected by the Fed funds rate. Those are short-term interest rates. You also got to think about corporate buying, so corporate real estate. That's short-term interest rates. That definitely has a cause and effect. When the Fed raises their interest rate, that will adjust that borrowing. So that will slow down that piece. And the design for the Fed to raise interest rates is to control inflation. Okay. Now, mortgage rates are influenced by all of this, but they're not directly correlated. So what we're seeing, you got to remember that inflation is a year-over-year reading. So everything that we saw last year was lower, right? Because the Fed said that this interest rate environment or inflation rate was transitory. And I think that we all smirk and we all laugh because we said, okay, if it's transitory, it's not going to last forever, right? Well, the Fed made a mistake in saying that because it ended up not being transitory. So with that being said, the only tool that the Fed has in their toolbox is raising interest rates. The inflation is increasing due to a couple of things. You have your core inflation, right? But you also have your commodity-driven inflation. So when you and I go to the gas pump and we fill up our cars, it's expensive, right? You're paying $6, $7 in some places I've seen for a gallon of gas, right? Your energy cost.
Some places $9 in California.
That's insane. So with that being said, those are commodities. The Fed cannot control food prices. The Fed cannot control energy prices. The Fed cannot control gas prices. They can't control the commodity-driven inflation. They can control their core inflation, right? So they can control that piece by raising interest rates and deterring spending, right? And that stuff takes a while to take effect in the marketplace, usually 3 to 6 months before we start feeling the effects. So all of our readings that we've seen this year are from last year. So we've been seeing some pretty drastic increases in inflation year over year. Now, what's going to happen in October when we get the reading in November for October's inflation numbers? You're going to start to see inflation actually come down a little bit because the reading from last year at that time was actually pretty high. We already started feeling the effects of inflation. So when we get our November read for October, which is a month behind, you're going to start to see inflation starting to come down. Now, the idea is the read from November for October's reading and December for November's reading, those are when we saw the higher inflation readings. So our numbers, right, year over year, we're going to start seeing a decrease month over month in inflation. Now, when we start to see that, Jason, you're going to start seeing mortgage rates come down relatively pretty quick. So going into fourth quarter of this year and first quarter of next year, we're going to have some real data. Now, the Fed has said, and Jerome Powell has said, I'm data driven. When the numbers start changing and we actually have some real tangible numbers, and we can say that inflation is starting to come down, that's when mortgage rates start coming down. And that's when the Fed does their pivot and maybe only increases by half a percentage rate or less. That's when you know the Fed has done their pivot, and you'll start seeing mortgage rates come back down.
And what does your crystal ball think about when that's going to happen?
Yeah. So we should start seeing fourth quarter of this year, and I really want you to mark your calendars. And if this doesn't happen, I will always eat crow and I'll always admit that I was wrong. But you should start seeing mortgage rates come back down in fourth quarter of this year. So December time period going into first quarter of next year will hopefully ring in the new year with some lower interest rates. Now, there's some caveats to that, right? So, and I'll always leave myself a little bit of a way out, but there are some caveats to that. You've seen commodities going down. Now, let's take gas out of the equation for right this very second, because we have some upcoming news regarding gas. But your lumber, your copper, think about your commodities. Those are starting to come down. You also have what's called demand destruction. So these higher interest rates are causing demand destruction. If you think about your larger retails like Target, like Walmart, think about your big box stores, even Lowe's, Home Depot. They have ordered so many products and so much inventory because of the supply chain and where we were last year that all this inventory is now starting to come in. Even Nike shoes has got an over inventory. So going into the holiday season, you're going to start seeing some real price reductions. That's called deflation. So my prediction is that the conversation we'll be having next year around this time, if not sooner, is on deflation as opposed to inflation. From a consumer, it sounds wonderful. We'll see prices coming down. However, for an economy, not the housing market, but for the economy, that can possess some other problems, and we'll talk about that on the next interview. So year over year readings, you're going to start seeing inflation start to drop in the fourth quarter of this year. So with that being said, we should see inflation year over year or month over month start to come down. And first quarter of next year, you should see interest rates. Now, when I say lower interest rates, I'm talking under 5%, but we're not talking pandemic lows of 2 to 3%. I think those.
You think we're ever going to get there again?
It's possible. There's going to be certain times where we have had 4 times where we've actually been in the 3% range without any help from the Fed. So you got to remember, the Fed was doing what's called quantitative easing, right? So the Fed was buying mortgage-backed securities at a huge clip. So they were pumping money into the system buying mortgage-backed securities. Now, when that was happening, that was causing your interest rates to go lower. Without any help from the Fed, we have actually been in the 3s before on multiple occasions. So can we get there again? Sure. Would it be as long as we had it the last time? Probably not. Those days are probably over in our lifetime, but you know what? Who knows? Anything's possible, and we've seen it.
So Chris, all right, well, where do you see the rates going like long term?
Sure. So long term, we're going to have to get this inflation really under control. So what we want to really focus on is if we can get that inflation to what the Fed wants to get to for their terminal rate. So when terminal rate, and what that means is the Fed is going to put their rates to a level that will accommodate a 2% inflation rate. Inflation is healthy in a marketplace. Inflation is not a bad word. Inflation at 9%, 10%, 11%, double digits, that is a bad word. But healthy inflation, 2 to 3%, that's a healthy functioning economy. So once we figure out what the terminal rate is and we can leave it there and get to a specific rate that will accomplish a 2% to 3% inflation rate, that's where we should see longer term rates stay less volatile and stay more in a normalized state. So that would be anywhere between 4 and 5% in a very healthy market. Now that's going to depend upon, what, again, the federal funds does with their rates and where they leave it for the terminal rate. Hope that makes sense.
Well, it is definitely, hard to wrap your head around, but that's
Sure.
what we had for Chris.
Absolutely. And I hope to break it down to you in an easier way to understand. When you do look at, the media, which we all do, when you're consumers, when you're buyers, when you're borrowers, we're all in this together. So we're all one big team. I think educating and advocating for the client is the most important thing to do, but it's breaking it down into simple terms that people can understand. I watch the market, you watch the market, so our consumers don't have to, and we can come to them and really break it down in a very easy to understand way. I know it can get a little bit complicated, but I think when we take the time and really walk people through this, this is where we win as an industry, and we help, people make a sound decision on home ownership.
So what is your answer to the magical question, is now a good time to buy?
Great question. So I always advise my borrowers that if they've got, so we got to remember, we're in the shelter business, right? This is truly a place to live. If we take the investment piece out of the equation and we really focus on the client and for a place to live, a place to create memories, a place to, grow a family, that's first and foremost. Again, we are looking at shelter. So if you can afford the payment, if you've got, the down payment, if you've got the assets to have your house payment go on if something were to happen to your job or your career or your financial situation, if you're able to make that payment, I do think it is a good time to buy a home. And the reason why I say that, especially in the market that we're in, and the easiest analogy that I can come up with for easy to understand is buying a home a year ago, 6 months ago, 2 years ago was like going to Target on Black Friday, right? People were kicking, punching on that TV that was the hot product. That was the house, right? That was the inventory. Now it's like going to Target on a Tuesday night. That's the way I feel. That's my favorite time to shop because you actually can, get a property and have your offer looked at. You can have some negotiation power as well, which you know way better than I do. But that, in my opinion, is a good time to buy a house. With our inventory the way it is, and you know how this is, with our inventory levels the way that they are, and especially with our millennial and Gen Z population, we have a huge amount of borrowers in the pool to buy a home with not enough inventory. So I do think the prices will still hold firm. So over time, they will appreciate, and I do think that is a good time to buy.
Yeah, I love that analogy because I don't care how cheap a TV is. I'm not going to go, deal with all of that. And I know over these last couple of years, some of these buyers have, had to deal with a lot of letdown as well.
Sure.
A lot of emotional, a lot of emotions running around when they kept getting their offers denied.
Absolutely.
So yeah, that could be tough. And what is the alternative for someone that is a first-time buyer? Either they keep on renting.
Sure.
Or maybe they can get into a house with the same payment as the rent. I mean, that's
100%.
That's what hopefully they could do, and it's still a better alternative. So yeah, if it is shelter, they need somewhere to live.
Yep.
You're going to be paying rent anyways. So yeah, that makes a lot of sense.
We always say that that our home buyers, even a first-time home buyer, they're paying a mortgage now, right?
Yeah, they're used to paying.
Exactly. They're paying somebody else's mortgage. So with that being said, home ownership, again, with the market the way it is, they can do it the way it's supposed to be done. They can really look at some inventory as opposed to jumping on the first house that they see because the emotions got into it. They can actually go out with you and look at more homes and, present some offers. We also have ways
actually inspect them.
Yeah, correct. That's exactly right. And actually go out to open houses and look at the neighborhoods and do some real research to make a sound decision. That part I do love. There's also ways, and we can probably talk about this on another time, but there are ways to get your interest rates close to 2021 levels. We have permanent rate buy downs. There's some creative ways to get that interest rate to something that would be more attainable to create a payment that's way more comfortable. So there are ways to do that.
Give us a quick elevator pitch, man. What do you got over there at Movement Mortgage that people, should know about?
Yeah, for sure. So I appreciate that. So If you look at a buy down, so we have a couple different things. You have a permanent rate buy down. You have temporary rate buy downs. So you have what's called a 3-2-1 or a 2-1 buy down or a 1-1 buy down. And what that means is, as opposed to asking the seller for a price reduction, perhaps you ask the seller for a seller's credit. We use that seller credit to buy the interest rate down. I'm going to give you a perfect example. Let's just say, and I'm not quoting rates right now, but let's just say the interest rate was at 6.5% today, right? You went to the seller and you asked for a $10,000 seller credit. We can take that seller credit and we can buy your interest rate down. Perhaps we could buy your interest rate down to 4.875%, right? On a permanent basis. For the next 30 years, your rate's going to be at that 4.875% and your payment would go accordingly. The other strategy,
something like that, 10 grand cover that buy down?
Sure.
Or would the buyer more money?
Yeah, depending on your loan amount. So the borrower can always chip in as well, but typically we will prep the client before they make that offer with the agent. So you and I would have a conversation. We'd all get together as a team, figure out what the cost is going to be on that buy down, and that's how we would structure the offer, right? On the other side of that, you have a temporary buy down. So temporary, you could do a 3-2-1 buy down or a 2-1 buy down or a 1-1 buy down. For illustration purposes, let's talk about a 2-1. If you take the seller credit, you can temporarily buy the interest rate down by 2% for the first year, 1% for the second year, and then it goes to the qualifying rate the third year and for the rest of the loan. So if your rate was at 6.5%, if you bought it down on a 2-1 buy down, your interest rate would be at 4.5% for the first year. Second year, 5.5%. The third year, and for the rest of the life of the loan, you'd be at the 6.5%.
Well, I definitely like the sound of the permanent buy down.
Sure.
Because, then you have that low interest rate for the whole loan. Not everyone's going to keep their house for 30 years.
Correct.
But yeah, I could imagine that, that third year is going to hit a little different than the first year with the 2% hike in the rate. So that might be a little bit of a payment shock. Who knows?
So I appreciate you saying that. And I am a fan of the permanent rate buy down. If you think about it, and if rates do start coming down, you've got to remember, if you do a permanent rate buy down and you can get that rate into something that's very comfortable for the client, it's going to save them money on the refinances. Okay. You won't have to refinance every time the rates take a move because you're going to take advantage of that lower interest rate. So it's going to save the client on multiple refinances over the years. That's the reason why I like it. It keeps the borrower, they are hedging against inflation. They know that their payment is going to be set for the next 30 years, as opposed to your rent payment that could increase year over year.
Right. No, that makes a lot of sense. I like that permanent buy down too. Now, what about, interest only? So I'm hearing a lot of talk about, why don't you just get like a 10-year interest only?
Sure.
So do you recommend those?
Yeah, it's a great product. So I think with the education piece, we really have to tune up our borrowers. Sometimes an interest only is not the best product for a first-time home buyer. Now, if it's an investment property, if it's someone that really likes that cash flow, an interest only is a great product because you're in a lot of control on your mortgage payments. You have a lower monthly payment, right? So you can invest it in different areas. Now, you can always add to the principal. And let's say you have, I'll give you a perfect example. My family, everybody's birthday is in May. My little boy is April 30th. My
birthday.
Right?
May 29th.
Okay. All right. So May is a busy month at the Conlon household. So April 30th, we've got little guy's birthday. May 2nd, we've got the middle one's birthday. My wife's birthday is on May 8th. And then we've got, Mother's Day right after that. So for May, I need the cash flow. I need that lower monthly payment. So I can make that interest only payment. And then for the rest of the month, I have that cash flow. Now the next month, or maybe in the holiday season, you want that extra cash flow. That's always a good time to have that interest only. Or if you're an investor, if you want that cash flow and you want to take that extra money and put it into other investments, great strategy. So Typically, we like to save those for our more, acclimated home buyer that's, used to buying multiple properties. That's really a good option for a first-time home buyer. Usually a 30-year fixed is the most appropriate.
Because their interest only is going to be every month,
Correct.
And that sounds like the old pick a pay loans that got everybody in trouble.
100%. Yes,
So I guess interest only would be one good option, just depending, especially if you don't plan on staying in the property 30 years.
Correct. Yep.
And then also the buy down. I'm hearing a lot about the buy down. Seems like everyone's talking about them right now. The house is listed at, 800,000. It's been on the market 85 days,
Yep.
Rather than offering, 20, 30 grand less, maybe you give them a full price offer and want that large credit. And I believe depending on the loan, you could get up to like 6%, right?
Yeah, correct. You are absolutely 100% correct. The other strategy on that, Jason, is if the home is, priced appropriately and you have comps to support it, like let's say you could even go higher than the asking price by $10,000 and still take that credit and use it towards your buy down as well. So that's another strategy. And that keeps the value of the homes, especially in that neighborhood, intact. Especially if you have other listings that are in there, you're not taking a price cut. So the neighbors tend to like that. The agents tend to like that as well. And if it's priced appropriately, that's a good strategy as well.
Yeah, we're not seeing any real appraisal issues yet, just because all the houses that previously sold were for way more money.
Correct.
So yeah, that's a good strategy as well.
Yep.
Well, man, Chris, that's awesome, man. Thank you so much. It's been helpful. I think we're at our time now. Appreciate you coming. So leave us in the comments. Tell us what you think interest rates are going to do. Are you waiting for interest rates to drop, or are you going to pull the trigger with interest rates in the 6%? I'm curious to know. Leave me in the comments. Chris, thank you so much for joining us. Everybody, please like, subscribe. Chris, before I let you go, how can everybody get a hold of you? If they want to price out a loan or, they can get qualified, what is the best method? I know you're heavily on Instagram.
Man, I appreciate that. I would always refer you back to my Instagram. That is the easiest way to get in touch with me. I have a link tree on there. You can get to me on any sort of communication piece that you like. It's C Conlon, so CConlon, super easy. I keep this stuff up to date. So Jason and I like to post at least 3 times a week and give you guys some updates on what's going on in the market. So if you like this type of kind of easy to understand, give me a follow. I'll always break it down, and I'm always here to help out for sure and really make you understand. Jason, I really appreciate you having me on here, man. This is what I love to do. This has been the best way for me to spend my morning and get to hanging out with a friend. That's the best.
Awesome.
So thank you.
Well, thank you, man. Hey, it was a pleasure, and we're gonna have to do another one of these. Let's do a follow-up one after the new year, especially, and see if your predictions were right.
I love that. Awesome. Thank you, sir. Appreciate you. Talk to you soon.
All right, everybody, if you liked the video, if you got some good information and you learned a lot, please remember to like, subscribe to the channel. It really helps. And please join us on the next one.